Welcome to Real Estate Investing for Professional Men and Women, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
All right. Hello, everybody. This is Gary Wilson, and welcome to this version of the podcast for real estate investing for professional men and women. Welcome aboard to you. Welcome aboard to all of you. All of you are professionals in your own respective fields. I'm glad to be helping you out here. So this podcast, again, is not like a be-all for everybody. This is really for folks who are professionals in their fields. Could be chiropractors, dentists. So some of you own your own practice. That's awesome. You could be a fireman, policeman, any one of 452 types of engineers. That includes software engineers, by the way. Pilots, airline, cargo, military, agricultural pilots, I think as a fireman, policeman, teachers, okay, accountants, could be any number of you. But the fact is generally speaking, when you see all the no money down stuff out there, you're skeptical, and you should be. I will tell you, it actually does work. It just doesn't work very well. It's actually far better if you can get to work from cash, which is what we're going to talk about on this particular podcast. Okay, lots of different podcasts coming from me to you on various subjects, all related to real estate investing for people just like us. I'm a professional too. I'm officially retired. I retired 15 years ago at the age of 40, and I never looked back because I was able to generate a substantial passive cash flow from buying income-producing assets, namely real estate. And that's what I'm going to help you do. Okay, so bottom line is this, guys. It's okay to borrow. I'm not against borrowing. I know I said we're all about cash, but that doesn't mean you don't borrow. It's just how and when you borrow. The other thing too is instead of borrowing to get into the property, to acquire the property, you acquire the property with cash through any number of means, which I'm describing to you, and then you can refinance with a traditional, regular term, regular interest rate mortgage, where you have great equity and cash flow still in place. The name of the game is this: if you're going to borrow against yourself, okay, which I'll talk about here going forward. So the good news is many others have done this before us, millions, by the way, and there's a great community with a lot of us in there. And some of us are real estate brokers who are trained to serve us, the real estate investor, specifically professionals, okay, people who are professionals in their field again. And you can be part of that. I'll describe that at the end of the podcast. But for right now, let's go ahead and jump right into it, guys, okay? So the last podcast, we talked about wraparound mortgages and land contracts. Okay, those are creative purchasing techniques that allow you to acquire certain types of properties in certain markets, depending on where we are in the market. What I want to talk about today is I'll start with what's called a blanket mortgage. A lot of people are confused about what is the difference between a blanket mortgage and a wraparound mortgage. Well, the basic difference is this. A wraparound mortgage is something you give to the seller that wraps around their existing mortgage. We already talked about that. What we're talking about in the next few minutes is what's called a blanket mortgage, which is you get a mortgage that basically covers or blankets your existing properties, okay? And by the way, for the most part, we'll discuss this in terms of them being existing investment properties. However, it could be a property that you own that you run a practice out of, for example. I've even seen blanket mortgages encompass your own home that you live in, okay? So it doesn't just have to be properties you own for investment purposes. It could be a combination of things. But the bottom line is this: let's just say, for example, you have 10 properties, okay? And I'll give you the example of me. I had 10 properties. Matter of fact, the first time I did a blanket mortgage, in fact, I think I owned exactly 10 properties. And I located a commercial lender, private lender, who was also a commercial lender. Okay, remember we talked about private lenders and commercial lenders a few podcasts ago, who was, of course, a professional in his field. And I met him through a local apartment association meeting. And he mentioned that he did private lending, and he was also a licensed commercial lender. So in other words, was a commercial mortgage banker, he had other investors at his disposal to package up and make loans to people. So in any case, the bottom line is this: I approached him with my concept of putting a mortgage across my existing properties in the equity that was in those properties. The reason I point this out is if you go to a traditional lender, like a traditional commercial lender, they'll often try to talk you into refinancing your properties with them so that they get in what's called a first position. They have a first mortgage position. All right. All that means is if you default, they're first in line to get their money back. Okay. They'll take the property, sell it for what they can, and recoup whatever their losses are as much as they can. Okay. They don't want to be in a second mortgage, which is this. What I did, I kept the existing mortgages on my 10 properties, and this gentleman took a second position on all 10 properties. Okay. And that's what I look for. I didn't want to refinance everything because I'd already owned them for a bit, and it amortized the balances down a bit. And I didn't want to start all over again with amortization because in amortization on a loan in the beginning, most of your payments are all interest, and very little goes to principal. And over time, you gradually increase the interest portion, decrease the interest portion and increase the principal portion. Well, I didn't want to go through all that over again. I already had pretty good positions on my mortgages. And he agreed. So he took a second position in a blanket mortgage that encumbered all 10 properties. Now, what was interesting is he drew up the liens, but he didn't actually record the liens on the properties. Okay. I thought that was interesting. But what he did say was, if I'm one day late on any of the payments, he's going to record all the liens. So now I would then have liens on all of my properties. Now, he didn't give me 100% financing. In other words, I didn't get, let's say I had, 200,000 in equity to tap into. Actually, that's about what it was. He only gave me 100,000. He gave me basically 50% of what I had in outstanding equity. Okay. So I still had 10% equity in my holdings. He basically gave me a loan against 10% of the holdings, which was half of the equity. And the other 80% was still tied up in the existing mortgages I already had on the properties. But nonetheless, that $100,000 was all I needed to go out and make my next move, which is exactly what I did. So I was able to go out and buy the next property. Now, in this case, according to what the seller saw, I was paying cash for the property. In other words, I didn't have to borrow money from a bank to buy the property. I didn't have to borrow from the owner, the seller, to buy his property. I borrowed against myself. I took money out from a third party private lender based on my own equity and my own properties. I essentially borrowed against myself. Okay, which means I was able to have a line of credit. I basically stroke a check to buy that 11th property. And then what I did is over the next year, I fixed it up, raised the rents, made it more valuable, went out and then got a brand new first mortgage on that property. Okay, which was enough for me to pay back the line of credit. Everybody follow me so far? So I took an equity loan out against the equity, a portion of my equity, 50% of the equity in my existing 10 properties. That gave me cash to go buy the next property, which I did pay cash for. Over the next year, I fixed it up, raised the rents, made it more valuable, then went out and got a brand new mortgage on that that was enough to pay back the line of credit. Now, here's what's interesting at this point. The private lender, liked doing business with me. So instead of us shaking hands and parting ways, he said, look, how about if you keep that? I'll keep it as a line of credit for you. You can draw on it when you want. And by the way, I'll increase the line of credit by the equity you have in this new property you just bought. So now the line of credit was up to 115,000. Okay, based on equity across 11 properties, not just 10, which allowed me to go out and buy another property, which I did. Now, this is just one technique. And by the way, that was the first time I did it. I got to move much more quickly through the transaction process. In other words, I bought the next property. I didn't take a year to fix it up and raise the rents. I did it within about 3 months. Went out and refinanced that property, paid back the line of credit, paid it down to zero. The lender again increased the line of credit. Okay, went out and bought the next bigger property. And this became a machine that I ran that worked every single time. And I did it every couple of months. And that was just one technique. Okay. But the bottom line is I do like blanket mortgages because it allows me to tap into equity that otherwise is just sitting there. Okay, I mean, I'm getting appreciation, of course, maybe 5% per year on average. But heck, if I can turn that around and buy another income producing asset, or I've got another chunk of equity and another monthly boost to my monthly cash flow, you better believe I'm going to keep riding that horse till the cows come home. How's that for euphemism? Ride the horse till the cows come home. Okay, that's what we want to do. So, in any case, I want to make sure everybody's okay on that. Again, blanket mortgage, awesome strategy. I highly recommend it. I've done it, dozens and dozens and dozens of times over the years. But we've got more to cover. Okay, so let's go over a couple of more basic things, and then we'll wrap this one up, and we'll do another podcast if we have to on this subject. But in any case, remember the theme here is borrowing against yourself. So what are some other ways we can do that? Well, one of those ways we can do it is if you own your own practice, you own your own business. Let's say you're an engineer and you happen to own your own consulting firm, or you own your own HVAC company, or you're a chiropractor or dentist or orthodontist or a family physician and you own your own practice. Well, hopefully that practice is set up, incorporated in the form of an S corp. Okay, which is what I'm not an attorney, but my suggestion is you speak to an attorney and let them know you have a service business, and they will more than often suggest a S corp for service type businesses. In any case, you've got yourself a corporation, an S corp. Okay, in fact, you may even own the building you practice out of, which would be great news. And if you're really having a great day, you not only own the building that houses your practice, but that building has other rental properties in there. Maybe you're renting out an adjoining unit to something related, like a vitamin shop, or a massage therapist, or a chiropractor, or any number of things related to your business. Okay, and maybe you've got some residential rental units upstairs in the top 3 or 4 floors. We like mixed use properties for service type businesses. But what I'm getting at here is you can borrow against that property. Number one, the property, by the way, should always be owned in a different entity than your business. So your business should be an S corp, and any property that you own should be in a simple LLC. Okay, not an S corp, just basic simple LLC for property ownership. What that means is you can borrow against the property, or in this case, in essence, you can borrow against the LLC, and you can also borrow against your practice. So this is what I want to talk about. If you're a little bit, if you're not too gun shy, all right, and you're willing to leverage what you've already got to generate more cash flow, build more equity outside of your practice, this is a great strategy. You can get a business loan, a business line of credit against your practice based on your historical performance. They'll look at your annual cash flow over the last few years. They'll look at your running balance and your operations account. They'll look at any number of things, as well as your what else you have, your personal home. Do you have any other assets? What other income are you generating from other investments, so forth and so on. But the bottom line is you can likely pull out enough from your business, from your practice, that'll give you enough for a down payment to buy another property. Now, remember, what you do is any additional property you buy should be in another LLC, separate from your practice. Okay, and I suggest in home and property ownership, my personal, what I do for me, guys, is this: is I never want to own any more than $1 million in property in any one LLC. So every time I reach $1 million in ownership, I will set up another LLC to buy the next property. But what happens is your business LLC, your business S corp for your practice, in this example, will make a loan to this new LLC. That new LLC will take those loan proceeds and go and buy this duplex or triplex or fourplex, whatever the case may be. And that LLC will also get a loan from the bank for the remaining, 70 or 80% that you need to finance. And you may have to co-guarantee that loan. In fact, even today, I still have to guarantee all my loans, and I've got millions. Okay, it's just another way for banks to protect themselves. But in any case, borrowing against yourself is a awesome strategy. If you can borrow against your practice, you give yourself permission to do that. Great way to leverage what you've already got. to buy these income producing assets so that you're not going to be stuck behind the chair forever, all right, in your practice, or if you're a engineer or what have you, you can get out of the cube every now and then and go out and enjoy life. Because here's the deal: when you invest in real estate, okay, remember it's not the end game. I know you may think it is right now, and I did too. I thought, my gosh, I'm going to buy all these properties, I'm going to make a lot of money, and then that's it for me. Nope. It actually turns out that acquiring these income producing assets is allowing you to build the foundation upon which you build other businesses or pursue other pleasures. Okay. In other words, you let the income producing assets fund your whatever it is, whatever your heart's desire, including buying toys. Let's say you want to buy a new car. You feel like you deserve that new Jaguar, and by golly, you're going to have one. You're 55 years old and you're tired of driving Toyotas. You want a Jaguar. Well, instead of going out there and buying the Jaguar personally, I mean, you can do that if you want, but why not leverage your income producing assets, leverage your triplexes and duplexes and fourplexes, use that cash flow, all right, to buy the non-income producing entity, which is this Jaguar. Now, I'm believe me, I love cars, guys. I love racing Ferraris and Lamborghinis and things like that. We do it every year. But I got out of the mindset that I actually have to own one of those things, because I didn't want to spend $450,000 on that car that I enjoyed when I drove it, but when I wasn't driving it, I wasn't enjoying it. It was sitting in my garage, basically requiring a lot of upkeep and financial terms, by the way, too. Just imagine what the insurance is on those things, right? So in any case, it turns out you can rent those things. Go to a racetrack, rent them for a day, and get your jollies out, okay? And save yourself a bundle of money. But if you feel like you're going to buy one, don't buy it personally. Use cash proceeds from your investments to fund that toy, all right? In any case, back to what I was talking about here. So let's do this. I went over blanket mortgage, and I went over borrowing against your own practice or business if you have one. If you don't have a business entity, if you don't have an LLC, I highly encourage you to start one. Again, for owning properties, you should always put them in LLCs. And over time, you may have enough income producing assets in your LLCs, your duplexes and triplexes and fourplexes, that you can get a business loan against those LLCs. Okay. The bottom line is it's an awesome strategy. Now, what we'll do, guys, on an upcoming podcast is I'll talk more about creative purchasing techniques, and we'll try to do more than just 2 examples. I'll try to wrap up basically course personal line of credit, home equity line of credit, whole life policy, using credit cards, and your own 401k if you have one, or self-directed IRA if you have one of those. And we'll go over, we might need 2 more podcasts, because I've also got an interesting technique called a rental participation loan. Okay. Kind of a unique way to borrow money. But in any case, let's go ahead and wrap this one up. I congratulate you for taking the time in your cars and your busy lives to listen. Just remember this: if you want to be part of the community, you can always go to myinvestmentservices.com. You can email support@myinvestmentservices.com. But online there'll be a form for you to fill out, and you can register for that. It's a monthly membership. We meet in person all over the country, different locations. On a monthly basis, we do weekly webinars, live, by the way. You also get the recordings of those. You get access to all the private lenders in your area. You get access to the real estate agents who are specifically trained to work with us. They're investor agents. They're a unique breed. There's only a few thousand of them. And also any other groups of professionals you need to contact, like insurers, for example. Lenders, of course, are in there. Even contractors, attorneys, and things like that. They're all in there. Also, you get to see who's paying cash for properties in your area. All kinds of neat stuff on there, as well as all the tools and techniques you need to be successful. So great, awesome place to be. Also, make sure, if you haven't already, go ahead and subscribe to the podcast. You can obviously find this on iTunes and iHeartRadio, but you'll see where you subscribe right there on your screen. Look forward to seeing you guys on the next podcast. All right. In the meantime, take care of yourselves, and God bless you and your families. Okay, take care, guys. Bye-bye.
Thanks for listening to this episode of Real Estate Investing for Professional Men and Women. Be sure to go to myinvestmentservices.com to join our community and start building wealth today.